The stock market just broke, and this time, it's not just numbers on a screen. It could hit your money, your job, the entire economy. And what triggered it isn't just some technical signal. It's something much bigger, something most people aren't even paying attention to yet. Over the past few weeks, a warning sign flashed, one that experienced investors haven't seen in nearly a year. And when this signal shows up, it usually means something underneath the market has already started to shift. Here's where things start to change. The S&P 500 just closed below a level called the 200-day moving average. Now that might sound technical, but what it represents is simple. For 214 straight trading sessions, almost a full year, the market stayed above that line, holding strong, moving up, confidence intact. And then suddenly, it didn't. That break isn't just a number. It's a signal that momentum may be fading, and something deeper is starting to crack. And this is where it gets uncomfortable, because analysts are now saying the real trigger behind this shift might not be the market itself. It might be the war. To understand that, you have to go back a few months, because not long ago everything looked unstoppable. To understand that, you have to go back a few months, because not long ago everything looked unstoppable. The S&P 500 hit an all-time high in late January, and it wasn't random. It was driven by one thing: AI. Companies were pouring hundreds of billions into data centers, GPUs, infrastructure, betting that artificial intelligence would reshape entire industries. And investors believed it completely. Stock prices didn't just rise, they stretched. Tech companies started trading at valuations that only made sense if AI delivered massive returns. Fast. That was the assumption. That was the bet. But then, something changed. The war began on February 28th. At first, markets didn't panic, because historically, wars don't always break markets. Investors have seen conflicts before, and most of the time, markets recover. But this time, something didn't follow the usual script, because this war didn't just create uncertainty, it hit energy. And this is where everything starts to accelerate. Iran shut down the Strait of Hormuz, one of the most critical oil arteries in the world, responsible for about 20% of global supply. At the same time, Qatar's LNG facilities were struck, removing a major portion of global gas supply for years. That's not background noise. That's a shock to the entire system. Oil surged toward $110 per barrel. European gas prices nearly doubled, and U.S. Defense Secretary Pete Hegseth made it clear there is no defined timeline for when this ends. Now here's where the chain reaction begins, because when energy prices rise, everything rises with it. Transportation, manufacturing, electricity, food, that's inflation. And inflation is where markets start to feel real pressure. Now watch how this plays out. The Federal Reserve controls inflation using interest rates. When inflation rises, they increase rates to slow things down. When inflation falls, they cut rates to stimulate growth. Coming into this year, investors were expecting multiple rate cuts. That expectation was driving everything. Because lower rates mean cheaper money, companies expand faster, profits grow, stock prices rise. Simple, but the war disrupted that entire expectation. Now inflation is rising again, driven by energy. So the Fed had to respond. This week, they held rates steady. But more importantly, they signaled maybe one cut for the rest of the year. Maybe. And that one shift changes everything. Because now money isn't getting cheaper, it's staying expensive. And that pressure shows up immediately. That might sound like just a number, but it touches everything. Mortgage rates, business loans, credit. And this is where tech stocks become extremely vulnerable. Because tech, especially AI companies, is built on future profits, they spend billions today expecting returns years down the line. When interest rates are low, those future profits look incredibly valuable today. But when rates stay high, those future profits shrink in value fast. So when expectations shift from multiple rate cuts to maybe just one, valuations don't slowly adjust. They snap, and that's exactly what we're seeing. On Friday, the Dow dropped 443 points. The S&P fell 1.5%. The Nasdaq dropped 2%. That marks the fourth straight week of losses, the longest losing streak in over a year. But this is where it speeds up. Because breaking below the 200-day moving average doesn't just reflect weakness, it triggers it. Algorithms start selling, funds reduce risk, positions get cut. Suddenly, it's not just people deciding to sell, the system starts selling on its own. That's how declines accelerate. So now the real question is, how far can this go? Goldman Sachs says in a worst-case scenario, the S&P 500 could fall to 5,400 this year, a 19% drop. Morgan Stanley sees a move toward 6,300 in the near term. Ed Yardney estimates a 10% to 15% correction. Now put that into perspective. A correction is a 10% drop from recent highs. We're already down about 5.3%. Another 5% and we're there. At 20%, that's a full bear market. And historically, breaking the 200-day moving average is often one of the early warning signs. But there's something deeper happening underneath all of this. This is the part most people are missing. The real mechanism here is something called stagflation, and this is where things get dangerous. Stagflation is when inflation rises, but growth slows. Energy prices push costs up, but at the same time, they hurt businesses and reduce spending. So the economy slows down while prices keep rising. That puts the Federal Reserve in a trap. They can't cut rates because inflation is too high. They can't raise rates aggressively because it would choke growth. So they're stuck. And when the Fed is stuck, markets become unstable. That instability hits tech the hardest because the entire AI boom was built on one assumption: cheap money. Companies like Nvidia, Microsoft, Google, and Meta have spent tens of billions building infrastructure, expecting fast returns in a low-rate environment. Now that assumption is under pressure. Analysts are starting to call it CapEx fatigue, meaning companies may start pulling back because the returns aren't coming fast enough. And once that happens, the story changes. Bank of America warned that markets may be underestimating the risk of this war. They said, whether volatility becomes a market correction depends on duration, not headlines. That line matters, because this isn't about the initial shock, it's about how long it lasts. If the war ends quickly and oil drops back to 70, markets could stabilize. But if this drags on, months, or even years, then the pressure builds. The Pentagon is already requesting an additional $200 billion, and there's still no clear end in sight. Which means energy stays high, inflation stays high, rates stay high, and profits get squeezed. At that point, markets don't just dip, they reset. Now, historically, geopolitical crises don't always break markets long-term. One study of 40 major events over 85 years showed the S&P 500 dropped less than 1% in the first month and gained over 3% within 6 months. But this time feels different because this crisis hits energy directly. And energy touches everything. Past conflicts didn't shut down major global supply routes for weeks. They didn't take out large portions of LNG capacity for years. This one did. And that's why the market feels fragile right now. Breaking below the 200-day moving average after nearly a year, above it signals something deeper. Not just a drop, a shift. The optimism from January is gone. And what's replacing it is doubt. Investors who bought near the top are now underwater. And when that happens, they start selling, which pushes prices lower, which creates more fear. That's how markets spiral. So this isn't just a market dip, it's a system under pressure from energy, inflation, and policy all at once. And if those pressures don't ease, this doesn't stay in the stock market. It spreads into businesses, into jobs, into the real economy. And that's when it stops being just numbers on a screen